Have you ever wondered why most investors struggle while Warren Buffett became one of the richest men in the world? The answer is simple. Wall Street doesn't want you to follow his strategy. Big financial institutions profit from people making impulsive decisions, but Buffett discovered a method that beats the system. In this video, he'll break down the exact principles that helped him build his fortune and how you can apply them to your own investments. Warren Buffett's passion for investing started early at just 11 years old. He bought his first stock. Unlike most kids his age, he was already fascinated by how businesses operated and how money could grow over time. But his first investments, didn't make him rich overnight? And he quickly realized that simply buying stocks wasn't enough. Over the years, Buffett experimented with different strategies, some of which led to painful losses. Like many beginners, he was tempted by fast profits and speculative trends. However, these early failures taught him one of the most valuable lessons in investing. Short-term thinking often leads to mistakes, while patience and discipline create real wealth. His turning point came when he decided to treat investing as a long-term game. He began focusing on studying businesses rather than just stock prices. This shift in mindset laid the foundation for what would become one of the most successful investment philosophies in history. But he didn't do it alone. He found a mentor who changed everything. In 1949, Buffett read The Intelligent Investor by Benjamin Graham, a book that would forever shape his approach to investing. Graham introduced him to a concept that would become the backbone of his strategy. Stocks are not just numbers on a screen, they represent real businesses. This realization changed how Buffett evaluated investments. One of Graham's most powerful lessons was the idea of Mr. Market. Imagine the stock market as a person who wakes up every day with different emotions, sometimes overly excited, sometimes irrationally fearful. Smart investors, Buffett learned, should not let Mr. Market's mood swings dictate their decisions. Instead, they should focus on a company's actual value. Another crucial principle was the margin of safety, the idea of buying stocks at a discount to reduce risk. Buffett saw that investing wasn't about gambling, but about making rational decisions based on solid fundamentals. With these insights, he began refining his strategy. But there was still one missing piece: finding companies with lasting competitive advantages. Many investors make the mistake of obsessing over stock prices, reacting emotionally to every rise and fall. Buffett, however, realized that the stock market's daily movements don't reflect a company's true value. Instead of following trends, he learned to dig deeper into a business's fundamentals, understanding what makes it profitable and sustainable. A key part of this analysis is looking at financial health. Buffett doesn't just glance at stock charts, examines balance sheets, revenue growth, and profit margins. If a company is drowning in debt or barely making money, he avoids it, no matter how popular the stock may seem. His motto is simple: invest in businesses, not hype. Beyond the numbers, Buffett also evaluates management quality and company culture. A strong business isn't just about profits, it's about leadership, ethics, and long-term vision. He believes that a great company should still thrive even if an average CEO takes over. This principle led him to one of his most important investing secrets: competitive moats. Buffett looks for companies with a moat, a term that describes a sustainable competitive advantage. Think of a cask lift. It has a strong moat. It's harder for enemies to invade. In business, a strong moat means competitors struggle to take market share. This can come from brand dominance, patents, cost advantages, or network effects. One of Buffett's favorite moat examples is Coca-Cola. With its global brand recognition, secret formula, and massive distribution network, it's incredibly hard for competitors to replace it. Other examples include Apple's ecosystem, Amazon's logistics, and Visa's payment network. These businesses have something unique that keeps them ahead of the competition. A key insight is that Buffett doesn't chase the hottest stocks she looks for, companies that will still be dominant in 20 or 30 years. This long-term thinking sets him apart from most investors, who focus only on short-term gains. But even after finding great companies, Buffett's method involves another crucial ingredient: patience. Investing isn't just about picking the right stocks, it's about avoiding bad ones. Buffett believes that most people lose money, not because they don't find good investments, but because they make impulsive, emotional decisions. His strategy? Say no to most opportunities and wait for the right ones. He often compares investing to a baseball game, but with one big difference: there are no called strikes. Unlike a batter who must swing at some point, an investor can wait indefinitely for the perfect pitch. Buffett waits until he finds an undeniably great business at a reasonable price. Then he buys with conviction. This disciplined approach has made Buffett one of the most successful investors of all time. Instead of constantly buying and selling, he holds on to great businesses for decades. The takeaway? Investing isn't about being the smartest person in the room, it's about having the patience to let your money grow over time. Now that you know Buffett's method, the real question is, will you apply it? Will you focus on long-term value instead of short-term hype? Will you have the patience to let your investments grow? The choice is yours. If you're serious about building wealth, start thinking like Buffett today. And if you found this video helpful, make sure to like, subscribe, and turn on notifications for more powerful insights on investing.